Well, natural gas futures climbed more than 1% again, pushing toward the $4.60 area, a level not seen since December 2022, driven by resilient export demand and traders once again anchoring their hopes on the possibility of colder weather emerging in early December. Still, for all the excitement, the broader weather setup tells a more subdued story. Most models continue to favor relatively light national demand through the bulk of the next 14 days, with only a brief window of moderate cooling expected early next week before conditions warm again. Forecasters are hinting at the potential formation of a colder pattern between November 26 and 29, but that signal remains far from locked in. Given how frequently early signals of cold air have fizzled this season, it's hard not to approach these projections with a raised eyebrow, particularly now that prices are already hovering at elevated levels. If the colder shift fails to materialize, the market may find itself priced for a winter that still hasn't quite arrived. Meanwhile, the fundamental backdrop remains decidedly bearish, with U.S. natural gas production still hovering near record territory. The EIA on Wednesday lifted its 2025 output forecast to 107.7 billion cubic feet per day, signaling that supply strength is expected to persist well into next year. Adding to that, market analysts estimate current U.S. dry gas production at roughly 110.8 billion cubic feet per day, more than 10% higher than the same period a year ago. This combination of robust present supply and upward revised future expectations continues to weigh on the structural outlook, even as prices attempt to climb on weather speculation. At the same time, U.S. gas demand on Wednesday came in at just 87 billion cubic feet per day. While that's a slight increase from a year ago, it still isn't enough to meaningfully shift the broader supply-heavy balance. Traders are also watching the steady climb in drilling activity, with the Baker Hughes gas rig count rising to 128 last week, the highest reading in more than 2 years. That uptick adds yet another layer of bearish pressure, reinforcing the view that supply remains more than adequate heading into the winter season. Meanwhile, analysts are looking for a storage injection of around 40 billion cubic feet in tomorrow's EIA report for the week ended November 7, a figure that leans mildly bearish compared with the 5-year average. U.S. inventories still sit 4.3% above typical seasonal levels, underscoring how comfortable the supply picture remains. Across the Atlantic, Europe's storage facilities are currently about 82% full, slightly below the 5-year average, yet still far from any threshold that would trigger urgent restocking or panic-driven buying. From a technical perspective, natural gas remains in a short-term uptrend, but upside momentum is starting to cool as the rally stalls near the heavy $4.60 to $4.65 resistance band. Indicators are edging into overbought territory, hinting at a possible pause or pullback. A break above $4.65 would open the door toward $4.75, but failure to clear resistance keeps the risk pointed toward a move back to the $4.30 pivot. Below that, stronger support sits near $4.20 and the 50-day moving average around $4. Overall, momentum favors bulls, but the setup looks stretched and increasingly sensitive to any shift in weather expectations. Moreover, trading volume during recent rallies has been somewhat inconsistent, strong on weather-driven surges but fading quickly when forecasts warm. This divergence hints that the rally may be running more on speculative enthusiasm than on durable conviction. Please don't forget to check out the ads and leave a comment to support the channel. See you next time.